on Australia's Business Channel. This is Debt to Equity.
We've only had returns, as I mentioned in the introduction, for that Chatswood property that kicked off these projects. But given the state of the property market at the moment and interest rates, et cetera, what kind of returns are you expecting for those other 7 funds?
The Chatswood project results were exceptional. They were 63% above what we had forecast. So we can't guarantee that they will always be the same. However, again, there's a lot of talk that the property market, there's a lot of issues. That people are predicting, a fall in the market. However, there's a lot of people predicting even more appreciation in the property price. When we look at the long term,
certainly in the short term, there's a depression there at the moment.
Yep, definitely. In the short term, we feel that there will be a plateau in the property prices, especially in New South Wales, Sydney. But there's a fundamental problem in the marketplace that there's a massive shortage of supply. There's predictions by end of 2009 that there's 200,000 dwelling shortage in Australia. In New South Wales, 80,000 of those dwellings will be in New South Wales. So, we've had population growth at 18-year highs, unemployment growth, unemployment at 35-year lows. We've had strong balance sheets. Households are willing to take on debt. So they've driven the prices up of property in the last few years, and those economic factors that we just mentioned, that's caused inflation and other indicators for the RBA to actually increase interest rates. So that has stopped developers from supplying because it's been harder to make things work. Obviously, as every day you open the paper, there's problems with planning issues as well. So it's hard.
And land releases
exactly.
as well.
Yes.
Exactly. So there is that fundamental issue of increased demand and shortage of supply.
So do you think that this will be a case of if you invest in property throughout, particularly, let's call the state of New South Wales, that over the long term you will get healthy returns?
Absolutely. You need to plan for a property on the long term. I think that a lot of people get carried away by buying a property, then valuing this property in 12 months, comparing with other properties, and property is the long term. It's not a stock price. It's not. You shouldn't go and think about it every minute. So are the fundamentals still there? Am I getting the return that I should be getting from this property? Because I personally can almost guarantee that over a period of time, the devaluation will always be up there. So as long as you can meet those repayments, as long as you can, you've got the fundamentals in place and in the right location, right property, you always do well.
It's also important to note that the rental market is also supporting the investment market. Our investors in our fund in Chatswood on the completion are now sitting on a yield of 5.9% on rental income alone, which for the property investor knows that's a very good return for a residential income, which has traditionally been around the 3.5% to 4%. If you're lucky, 4.5%, but they're sitting on 5.9%, and that will encourage some investors to come back in the market. However, for some of the other reasons that it will be a bit difficult. We will see a bit of a plateau, but in the long run, there will be appreciation in prices because of the fundamentals.
Just quickly, you're looking for another property to develop. Is there anything on your wish list at the moment or on your radar that
there are?
Like?
There's a big big story of empty nesters. At the moment, a lot of people say, look, there's empty nesters that are moving from their traditional homes into apartments, expensive apartments. But we don't buy that story. We're looking at having supplying the market with affordable housing. In other words, affordable quality housing between the $600,000 to $750,000 range. A lot of developers are in the market to supply empty nesters of $1 to $1.5 million. This is North Shore we're talking about. It's North Shore of Sydney. To $1 to $1.5 million market, and that I think is a little bit thin because people need to have change after the downsize. They can't sort of sell their house in Killara and buy another unit in Killara for $1.5 million. So they need to get change, and I think those that market will dry up soon. This is what I believe. But we're focused on delivering affordable housing, probably, with a range between $600,000 to $700,000.
All right, Michael and Stephen Abalakian, many thanks for coming in and giving us a bit of a commentary on the current state of the property market. And that's all we have time for. If you've got any questions for our fund managers or a specific fund you'd like us to feature in the program, please drop us a line, yourmoney@skynews.com.au. I'm Diana Dorothy.